Hey traders, Jason here from Leavitt Brothers. I hope you're well. Today I'm going to do a state of the market review. A couple weeks ago I did a video comparing previous bear markets, see what typically happens after a big sell-off. You can find it on my YouTube channel. Then after that I did a video where I talked about, or I offered evidence that was consistent with what typically takes place at the beginning of a bigger bear market. And I argued that what has taken place over the previous month, what had taken place over the previous month, was more consistent with the beginning of a big bear market than like a pullback within an uptrend. So you can check that out. It's also on my YouTube channel. Okay, so today I'm going to run through the S&P 500 on various time frames. I'm going to talk about some indicators just to see what the current state of things is. Okay, we know the market has registered some stats that put it in a rare category. In several cases, like things have happened in the last month that have not taken place since the Great Depression. For example, this was the fastest bear market in history. Okay, it only took 16 days to go from an all-time high to a 20% drop. We define a bear market as a 20% drop. It's the fastest it's ever gone from a high to a 20% drop. Last week, we got the biggest three-day bounce since the Great Depression. The S&P went up like 17.55%, I think, in 3 days. The Dow went up even more. It went up like 21%. Okay, fastest bear market in history, biggest three-day bounce since the Great Depression. Okay, but big bounces are normal. Okay, during the 1973-74 bear market, there was a 20% rally before the market rolled over and continued down. During the 2000, 2001, 2002 bear market, there were 3 bear market rallies, 22%, 25%, 24%, and the market eventually went down 51%. During the 2007-2008 bear market, there was a 27% bounce before the market eventually sold off again and eventually fell 56%. Okay, so bear market rallies are very normal. So what took place last week is like very much within the scope of what typically takes place. So it's nothing to get overly excited about. I mean, certainly it could morph into a full-blown rally, but I think right now trend is down, bear market is in place. Expect these types of big rallies to take place, but don't get overly excited unless the indicators turn and suggest that the worst is behind us. All right, so let's run through some charts. Let's get an idea of what is going on here. Okay, so here is the S&P monthly. Okay, going back 12 years, 13 years or so. Okay, so the S&P monthly, the 50-month moving average has been a pretty important level. You see support there, and we're right there. Does it matter if it closes? We only have 2 more days this month. Does it matter if it closes just below or just above? Probably not. I'm not going to be too much of a stickler as far as the exact level. To me, the most important thing is what happens next month. If we get candles that start to form, monthly candles that start to form like this below the moving average, that's a problem. Okay. If we get candles that start to form like this, that'd be a good sign. Okay, we see what happened. That's the big thing I'm looking for. You can see what happened like back in 2008 where you had the 50 was taken out. Then you got a couple candles that got kind of trapped below the moving average, and then the market fell apart. I'm kind of looking for that right now. Can the market establish itself above this moving average? If so, that'd be a great sign. If not, if we get a couple candles here, here, then we're going much lower. Okay, so that's what I'll be looking for. Obviously, with the monthly chart, it's going to take some time to play out. This month's close, kind of important, but not. I'm not going to be a stickler as far as the exact level. I'm mostly interested in like how April starts to form. All right, moving on. Here is the S&P weekly. You can see the 50-day moving average in blue. The red is the 200. You can see support there at the 200, support there at the 200. And right now we have resistance at the 200. Okay, so we got a nice bullish engulfing pattern. Market opened up near its low, tested lower, tested below the previous week's low, rallied up, tested moving average up here, and then fell back, but still closed above the previous week's open. So it's kind of a bullish engulfing. In the near term, it's somewhat bullish, but I consider this to be a really big and stiff resistance level. Okay, if you start getting candles that form here, the market's going to head back down. At the very least, it's going to test those lows. But if we can get above here and start to get some candles, then hey, maybe the bulls could actually take over and rally this thing back up to 3,000 or so. Okay, don't guess. Be flexible. Be open-minded. Don't be stubborn. We're pretty much right under a very important level. Let it guide you as opposed to guessing what's gonna happen. All right. People who have really strong opinions right now, I guess that's okay as long as you have the ability to exit positions if the market doesn't go your way. But again, this is a really important level, somewhere up in the mid 26s. Right now it's 26.43, so that's a level to look out for. All right, let's go zoom in with the daily. So last week's bounce, biggest bounce since the Great Depression, all it did is get us up to like the first major fib level. The 38.2 retracement level approximately. Okay, so big bounce, didn't really accomplish much. Okay, it got above, here's the 8 EMA, and here is the 21 EMA. I consider both to be really important. So for it to get above the 8, that's important. It kind of got rejected by the 21. Now it's coming back down to the 8. It's not that bad of a sequence. Okay, if it could hold the 8 on the way down and get kind of compressed between these two moving averages, I think it'll be set up to try and do this. But if it comes down next week and takes out the 8 and then maybe gets trapped underneath the 8, that'll be a problem. Okay, oftentimes when there's a big gap in between moving averages, oftentimes it'll get through the first but get rejected by the second, and it needs more time to consolidate before it can take out the second. So that's what I'll be looking for next week. Daily chart. So this thing could, in theory, let me get rid of some of these lines. This thing could, in theory, move sideways, allow these two moving averages to get a little bit closer, and then it could pop out. Don't know. It's hard to tell. I don't want to make any predictions. Like overall, the trend is down. I would consider this moving average to be pretty important, and it actually lines up with previous charts. If you go back to the monthly here, key level right around 2600, the weekly key level right here at like 2640, come over here to the daily key level right above 2650. All this thing is going to adjust down quickly because it's a daily chart. So this area between 2600 and 2650 is pretty big, a lot of resistance, numerous moving averages and time frames all come into play. So it's going to be tough to fight through that level, at least on the first attempt here. So if you're long, you definitely want to be careful because there could be some backing and filling from this level. All right, let's move on. So quickly, here's the hourly chart. I consider the 50-hour moving average to be pretty important. It typically forms my near-term bias, although nowadays it's kind of hard to say what a near-term bias is because the market could rally 200 points on a day and then turn around and give it all back the next day. So instead of having a nice, smooth, gentle movement where, for example, here the market spent almost 3 entire weeks above the 50 moving average. Here it spent 3.5 weeks above the 50 moving average. So you can actually have a bias and like stick with that. But like right now, you could be above the 50-hour moving average and still get a 200-point drop, which is like way too big to actually just sit in position. So I typically use it as a bias, but not right now, not as much right now. All right, so now let's look at some indicators. Here is the SP 500. We have the 10-day 80 line. We have the cumulative 80 line. So you guys know the routine here. In order for an uptrend to establish itself, it's going to have to get, the 10-day is going to have to get above 0 and actually just kind of oscillate up there. Okay, that's all you want. That's what's going to need to take place. If this thing gets rejected, right now it's right near 0. If it kind of gets trapped under here, the market's going to come back down. If it can establish itself above 0, that'd be great. Well, great for the bears, great for the bulls, I should say. Don't guess, let it guide you. Don't predict. I think a bigger issue right now is the cumulative line down below here. You got support at the 50, and you can see how it got below the 50 and seems like to be rolling over. So if this can get above the 50, fantastic. But if it doesn't, If this thing comes up and gets rejected and starts going down, it's, you know, at a minimum, market's going to go back to 2000. Okay, that's the big thing right now. If you look over here in the late 2018 time period, where it got below, tried to get above, rejected, tried to get above, rejected, and kept going down, like that, just, you know, the market just kept going down. So unless this thing, unless the 18 line can get above its 50, bias, overall bias should be to the downside. All right, here is S&P 500. We have new highs, new lows, and then the high-low differential. New highs, you know, when the market is healthy, you get new highs tend to oscillate somewhere in the middle. Not too high, not too low, just kind of in the middle. Obviously, we got low prints now. When the market starts to weaken, you start to get an uptick in new lows, which is what we got starting here in January. They maintained a high level above its 50, and then they started moving up again. All right, so right now they're at a really low level thanks to last week's bounce. If the market consolidates like right in here and we start to get an uptick in new lows, that's going to be a bad sign. But if the new lows can stay at a low level, that'll be a good sign. Good sign for the bears, for the bulls, I should say. Now, with the differential, I'm going to zoom in here in a second. But the differential, you generally want just this to trend up. Okay, if new highs are consistently beating new lows, trending up above the 50, it's a great sign. Obviously, we're not there right now. 50 is way up here. If this thing kind of comes up and gets rejected, so even if we do get a nice bounce here and the new highs start to expand and this thing can't get above its 50, that's going to be a problem. So I'm going to zoom in on the high-low differential to a previous time period just to give you a better idea of how this tends to act. Okay, so here's 2007, 2008, 2009, and you can see the high-low differential. You know, we got a nice divergence here. Unfortunately, we didn't get one this time, but dropped below its 50, recovered, but then got rejected. And you can see how, you know, big bounce here, kind of slid down, didn't expand much, and they got rejected. Got a decent bounce there. Same thing, just moved sideways, got rejected. Continue down. So that's what we're going to be looking for. Okay, it's an after the fact confirmation. If we do get a big bounce, you know, like this, like this, like this, the question is, can this get above its 50, and can we actually start to trend up, or is it just going to is it going to get rejected and continue down? That's what I'll be looking for right now. Okay, here's percentage of stocks above their, you know, 20, 50, and 200-day moving averages. When the market's healthy, you get prints, you know, like this. Same thing with the 50. The 200 will be lagging. That's what I'm looking for right now. All these charts are still in bear territory, despite the fact that we got a really great bounce last week. If the bulls want their case to be supported, we need more stocks to be trading above their 200. We need eventually more stocks to be trading above their 50. I don't expect it to happen right away because the drop was so stiff that the 50 is like, you know, coming down over here somewhere. But in time, if this thing consolidates and moving averages start to move down, we're going to want to see an expansion here. If it doesn't, market's in trouble. Okay, you know, if this thing moves up and gets rejected by 50%, market's going to leg down. If the percentage of stocks above their 50 gets rejected by the 50, market's going to roll over and move down. Again, this will be an after the fact confirmation or non-confirmation. Okay, the market could go up or down 200-300 points at any given time in any week. If these indicators support that, great. If they don't, then we know that 200-point rally was a great rally, but it's not going to last and the market's going to reverse. All right, so overall, we got a really nice bounce last week. For those of you who are bearish, and I'm bearish overall, it just adds to the potential downside. Instead of there being like maybe another 500 points available to the downside, now there's 800 because we're that much further off the low. The S&P monthly is sitting near its monthly 50. The weekly is sitting near its 200. The daily has simply bounced to its first major fib level, which happens to be the 21. I consider what took place to be a bounce within a downtrend, not the beginning of a lasting uptrend. Okay, anything goes near term, like literally anything. A 100, 200-point move in either direction can take place at any time. But overall, we're very likely to see lower prices. Okay, we're very likely to see a double bottom, and it's not that far-fetched to get a double bottom. That's where we get a double bottom now, and then maybe there's a break during the summer, and then we get another double bottom in the fall, maybe next winter. Okay, my number one piece of advice is don't be stubborn. things can change fast, and as bad or as good as the market may be at any one point, it could reverse very quickly. Okay, thanks for listening. You can follow my YouTube channel by clicking the red subscribe button. And while you're sitting at home, take my mini masterclass in trading. It's free. There's a link below. See you next time.